Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. You know, in what investors thought was going to be a nice start to a weekend in May got turned around with that late Friday announcement that Moody's had just downgraded the U.S. long-term credit rating. And given the current uncertain and volatile investment backdrop for investors, the initial early reactions of selling Treasuries was to be expected. However, this is where one needs to step back and put this announcement into perspective, and that's what I want to do today. So first, the facts. Moody's downgraded Treasuries one notch to AA1 from AAA and updated its outlook to stable from negative. This was not a surprise move at all. Moody's had telegraphed it in a relatively recent report and had the outlook already at negative, typically a precursor to a potential downgrade. Treasuries were already officially not AAA after Fitch's downgrade in 2023, so it just brings Moody's in line with S&P and Fitch, which is one notch below AAA. And as far as the potential for further credit rating agency action, all of these big three, Moody's, S&P, and Fitch, now have Treasuries at a stable outlook. And a stable outlook usually becomes negative before another downgrade occurs. So consider it basically a couple steps away. How about market reactions? Well, let's go back in time. When S&P downgraded the U.S. in August 2011, Treasuries were viewed as a traditional hedge for risk-off trading. So as a result, the 10-year Treasury yield actually fell 24 basis points in day after trading due to the knee-jerk selling in the equity market. Now, when Fitch downgraded the U.S., the Treasury 10 yield rose a modest 6 basis points in day after trading. And as we're talking to you right now, the Moody's downgrade initially resulted in about a 6 or 7 basis point increase in the Treasury 10-year yield. But as I'm recording this, much like the Fitch episode, which we saw with the 6 or 7 increase, but now it's almost little changed. So that brings me to my last point. No selling America. Tina for Treasuries. Remember Tina? There is no alternative for stocks. The same concept applies for foreign Treasury holders and where to invest their U.S. dollars. The total amount of marketable Treasuries outstanding is more than 3.2 times the size of the entire global ag AAA universe. Numbers, 28.6 trillion Treasuries, 8.9 trillion the global ag AAA universe. And here's a sampling of some of the other sovereign debt countries with AAA ratings: Germany, Netherlands, Switzerland, Singapore, Australia, Denmark, Sweden, Norway. Now, Germany recently voted for a massive increase in government borrowing to alter its debt brake, and that's a rather visible shift potentially in their own fiscal outlook. What's the bottom line to this no selling America? Global investors are still going to buy Treasuries. And so for me, when you're taking a step back and looking at this, as we've seen after the two prior downgrades, the fundamentals, economy, inflation data, and Fed policy, they will ultimately determine direction and magnitude of yield movements, and we see no difference this time around. So I wanted to just get that out there for everybody. Please, if you have any questions, reach out to us. That's what we're here for. And like us out there on the various platforms that you see us on, and let us know how we're doing. Have a great rest of the week, everybody, and be well.